Here's a great one. It's $3. How much can I lose? This is a great one. Because yeah, get out. This is, I don't have a computer and I can't do high-level math, but just do this one. So let's say your neighbor buys $10,000 of a stock at 50, and the stock's now 3, and you put $25,000 in at 3. If it goes to 0, who loses the most? A lot of people cannot answer this question. You know,
Between 1977 and 1990, Fidelity's Magellan fund appreciated from $20 million to $14 billion. That is, with an annual appreciation of 29.2%. Who are we talking about here? It's the greater investor and living legend Peter Lynch.
Well, obviously the market's gone up tenfold since I stopped running Magellan. So you make more money on the upside. The market's going to be a lot higher in 10 years from now, 20 years from now, 30 years from now. Trying to predict the market is really a waste.
If we translated his success into a $10,000 investment at the beginning, after 13 years you would own $280,000. That represents the aforementioned 29.2%. Over the same period, the S&P 500 averaged only 15.8%. In today's video, we'll talk about who is Peter Lynch, Lynch's investment philosophy, common traits for stock picking, fundamental analysis according to Lynch. What books has Peter Lynch written? Who is Peter Lynch? Peter Lynch is an American investor born in 1944, mutual fund manager, author and philanthropist. He is widely regarded as one of the most successful investors of all time, and his investment strategies have been widely studied and applied by investors around the world. Peter Lynch's investment philosophy. He emphasizes investing in companies or industries that you understand well. He believed that investors should focus on companies with strong fundamentals and attractive growth potential. Lynch was a long-term investor who believed in holding on to stocks for many years. He was known for his ability to identify hidden gems, stocks that were undervalued and had significant potential for growth. Lynch believed that investors should be patient and wait for the right investment opportunities rather than being swayed by market noise. Lynch's investment strategy involved a combination of growth and value investing. He used the latter to find stocks trading at reasonable value but used growth principles to find opportunities for rapid business growth. Lynch also believed in taking advantage of market inefficiencies by looking for undervalued or overlooked stocks. He was a proponent of fundamental analysis, which involves researching a company thoroughly before investing. Let's summarize the main points of Lynch's investment strategy. Buy what you know. Invest in companies or industries that you understand well. Focus on companies with strong fundamentals and attractive growth potential. Identify hidden gems, stocks that are undervalued and have significant potential for growth. Use a combination of growth and value investing. Conduct thorough research before investing in any stock. Take advantage of market inefficiencies by looking for undervalued or overlooked stocks. Be patient and wait for the right investment opportunities. Hold on to stocks for many years. Let's look at the common traits for stock selection according to Lynch. The product is simple, easy to understand and like. Hanes underwear is a beautiful example. His wife Carolyn was buying it, so Lynch did an analysis of the company and his investment in Hanes increased sixfold. PEG, Price Earnings Growth Ratio. It was Lynch who made this PEG ratio famous. His attention was particularly drawn when a company had a PEG ratio of less than 0.5. The PEG ratio is a selection tool for gap or growth at a reasonable price. The lower the PEG ratio, the relatively cheaper the stock is relative to earnings growth. Finding boring companies. He liked to look for companies like Bob Evans' Farm that could provide a discount of a few dollars on the stock price. Like Warren Buffett, he avoided technology companies, preferring to invest in ordinary businesses. Companies that the company for some reason condemned. Lynch saw opportunity in companies about which there were negative rumors. He once said, invest in a business that is rumored to use toxic waste or is in the hands of the mafia, ideally both. Niche companies, repeatable sales and/or management buying their own shares. All of these small indicators were seen by Lynch as interesting opportunities to buy shares of companies that are undervalued and with high growth potential. However, all these discounts in share price do not mean that they are a reason to buy the stock. This is just the beginning. What follows is a lot of analysis and sorting of stocks to find gems with growth potential and fund appreciation. Fundamental analysis of stocks according to Lynch. Lynch distinguishes 6 categories of stocks which he considers separately. Fast growth stocks, in the long run earnings per share EPS grow 20% or more. These are Lynch's favorite stocks. Stalwarts, long-term earnings per share growth between 10% and 19%. Slow growth stocks, earnings per share growth below 10%. These stocks generally do not have his attention. Turnarounds. Companies that have been in trouble but have recovered. Cyclical stocks. Companies that operate in industries with cyclical ripples, e.g. basic chemicals and investment goods. Asset players. Companies with special assets that are not directly visible on the balance sheet, e.g. buildings that were acquired many years ago and now cost the balance sheet at cost. A large profit could thus be realized on sale. Lynch evaluates these stock categories separately, but for all categories he looks at PEG ratio. The lower the PEG ratio, the better. This means that investors have to pay little for nice earnings growth. In any case, the PEG must lie below 1 and a PEG below 0.5 is idle. For stalwarts and slow-growing stocks, the dividend yield is also taken into account in the PEG ratio calculation. Change in the inventory sales ratio. If this ratio is rising, it means that the company is producing more than it is selling and has therefore estimated sales too optimistically. This is not a good sign. The criterion here is that this ratio must not increase more than 5% per year. The debt-equity ratio should not exceed 0.8, preferably even below 0.5, except for financial institutions or public benefit corporations which are more debt-financed. For financial companies, equity capital must comprise more than 5% of total assets, a value of more than 13.5% of assets and a return on assets greater than or equal to 1% are preferred. In order to be able to pick stocks based on Peter Lynch's practices, I recommend studying his books. One Up on Wall Street: How to use what you already know to make money in the market. Beating the Street: How to beat Wall Street on its own ground. Learn to Earn: A beginner's guide to the basics of investing and business. Lynch's books are highly recommended by Wall Street experts. They are written in down-to-earth and accessible manner and provide advice on how to buy and sell stocks. Even experienced stock traders can learn a lot from these books, as Lynch often explains his best and worst decisions in detail. Lynch's books often emphasize the advantages that independent investors have over brokerage houses and large funds. He also emphasizes the role of common sense and thorough research in investing. Peter Lynch is a financial titan who is one of the long-term value investors like Ben Graham or Warren Buffett. Lynch's investing combines rationality and understanding of markets and traded companies, a deep knowledge in fundamental analysis and also the necessary patience. All of this, when combined with the ability to trade large capital, means only one thing: a legend is created, which Lynch undoubtedly is.
But I'll guarantee you the market will be a lot higher in 15 years. It'll be a lot higher in 25 years. What it's going to do in the next 1 or 2 years, I don't have any idea. And if somebody in this room knows about it, they're not telling anybody.
Thank you very much for watching to the end. Have a great time, educate yourself and invest wisely.